So another stock analysis video today, guys. One of my viewers on the how to pick stocks video, the first one that I did, requested that I did a follow-up video looking at some more telecom companies. So that's exactly what I've done with this video. I've picked 4 telecom companies that I've analyzed, and I'm going to walk you through the same kind of analysis process that I went through in the last time. And this time we're going to throw in an additional step where I take a look at them through the lens of a brand new app that is looking to change the world of DIY investing. So let's get right into the video. What's up, guys? My name is Johnny. Welcome to Millennials with Money. I upload content to YouTube every Wednesday and Sunday, giving you tips on how to take control of your money today to create a bright financial future tomorrow. If you like what you see on the channel, why not hit the like button, click subscribe and hit the bell for notifications and become a member of the ever-growing Millennials with Money community. So the 4 companies that I'm going to analyze in today's video are Vodafone, Swisscom, Telenor and Proximus. So they're all European telecom operators, and I'm going to tell you a bit about each one of them now. So a lot of people watching this video have probably heard of Vodafone. They have a big presence in Europe in countries like the UK, Germany, Italy, Spain, Greece. And they also have operations in the rest of the world in countries such as Egypt, in New Zealand, which I think they're disposing of actually, and also in South Africa. Now Swisscom, I think the name kind of gives it away. It's a Swiss telecoms operator. They operate within Switzerland, and they also operate kind of an internet service over the border in Italy as a small part of their operations. Proximus is a Belgian telecom operator, so they operate under the Proximus and Scarlet brands within Belgium, and in Luxembourg they operate under the Tango and Telindus brands. And they also have an arm of their business called Bix, which is a voice carrying service and also a mobile data services provider. So that's Proximus in a nutshell for you. And Telenor, which operates within the Nordic markets, so Norway, Finland, Denmark and Sweden, and also operates in some Asian countries such as Pakistan, Bangladesh, Myanmar and Thailand. They also have a small part of their business which does maritime telecommunications, so Wi-Fi when you're traveling across the sea, or communications kind of at sea. So if you're ever at sea on a ferry, don't make the mistake that I did. Turn off roaming on your phone, otherwise you will see that bill racks up quickly. That was a painful one to take. So I'm going to take you over to my desk now. We're going to have a look on the computer of the analysis that I've put together, and I'm going to talk you through my take and my perspective on these 4 companies. Okay folks, so you probably remember the Excel file that you see on the screen right now. So what I've done is I have set that up for the new companies, and we're going to walk through it. I was actually going to include Vodafone in my original video that I did, but based on my findings in the analysis, I decided to exclude it. And I still feel the same way after doing some research. So I'm going to quickly go through that now and explain to you my findings on Vodafone. So I mean, if you take a look at the Excel here, you can see it's in the red. I've highlighted it red for a lot of metrics here because I'm not too confident on how it's doing. You can see revenue growth continues to go down over 10 years. Really low gross margin, and net profit growth is also down. The main thing for me, the biggest red flag that I see in Vodafone is the fact that it has made a loss in 3 of the past 5 years. So if we take a look here at the revenues in Morningstar, you can see here along net income available to common shareholders, you can see it's mainly negative numbers there. So it's really not looking good from a profitability perspective. I had a read into why that may be. So when I looked into their profitability struggles a little bit more, there seems there's 2 factors in play. So one is kind of that they have really strong competition in Italy and Spain, which is really making it hard for them to be profitable. And another reason is that they decided to dispose of some assets in India, part of their business there. So I guess perhaps they ran up some costs doing that, and it's damaged their profitability as a result. Their recent quarterly reports say that they are now generating a profit, so that could be good news. And they are starting to have a cleanup kind of their portfolio. So clearing out kind of assets and businesses that are not generating a profit for them and looking for new opportunities to replace them. So this could be the road to kind of recovery for Vodafone. But for me, there's just too many red flags at this stage. I mean, you see kind of across here, so accounts receivable to sales. Remember, that's the percentage of trade receivables to revenue. So the greater that percentage is, it means the longer, in theory, that that operator is taking to get paid. You can see they're taking a lot longer than the likes of Swisscom, Telenor, Proximus. Even if we go back to the old analysis, I don't think there's only KPN kind of up there near the 9% mark. So bit of a concerning situation, and again, cash flow. So if you kind of annualize their cash movements over 3-5 years, you'll see there's massive cash movements going in and out of the business. Personally, I would look for a stable cash situation where kind of the movements are pretty regular, or kind of you got a stable cash flow balance, or at least explanations kind of behind what's going on. But for me, yeah, there's a lot of red flags for Vodafone. So we're gonna put that to one side and we're gonna look at the other three now. So we're going to look through these indicators by business for each of the three companies. So we're going to look through a category at a time. So let's start with profitability. So you can see here, Telenor has the biggest revenue growth, so 2% per year annually, annualized over 10 years. Remember in my last video, I explained that I take the average growth percentage year on year over 10 years because I think it's more representative of regular growth kind of over the long term. Remember, if you have some outliers or anomalies, so really high revenues or really low revenues in 1 year, it can distort that growth calculation and it can make you misinterpret kind of how well the business is able to grow their revenues. That's my justification for using the year-on-year growth. So I've also got sheets for each business in the book. So if we take a look at Telenor here, you can see it's a nice upward revenue trend there, gone down from 2017 to 2018. Be interesting to find out what that was, and then recovering again in 2019. And then Swisscom, we saw it was 0%. So those revenues kind of really stable around 12 billion Swiss francs every year. And then Proximus, you can see that over time sales are slowly decreasing. I think that Belgian telecom market is particularly competitive. So you have Proximus, you have Orange in there as well. So Orange, another big player obviously in the telecom company. So yeah, a lot of price competition going on in Belgium. And then if we look from a profitability perspective, so Swisscom, clearly the most efficient operator here, netting kind of 13.4% of their revenues as their net profit. And then you got Telenor and Proximus, which are kind of around the 8% mark. So it's not bad, but very impressive from Swisscom here to see that they're kind of nice and efficient in the way they're operating. So clearly Telenor the winner here in terms of generating growing revenues. However, Swisscom, as we can see, is the most efficient operator as of the revenues it generates. It manages to take home the highest net income. Now let's have a look at leverage. So remember, this is use of debt and kind of their debt position. So we can see Swisscom and Proximus between 0.8 and 0.9 for current ratio. As I said in the last video, I'd ideally like that over 1, but it's not too far below for it to be concerning for me. Telenor, however, at 0.69, that's a little bit lower than these two, and it's clearly less able to meet its short-term obligations compared to Swisscom and Proximus. Now if we get on to gearing, so Swisscom and Proximus both around the 50% mark. Remember we said in the last video that that's kind of normal in the telecom sector, so nothing too much to be concerned about for those companies. Telenor, however, we can see that debt very high, so about 77%, so 80% of the company's finance is in debt. For me, that's a big red flag. That's very worrying. And in the Telenor sheet here, I've kind of got the evolution of that gearing ratio over 5 years. So you can see at one point they were kind of around the 50 to 60% mark. So again, quite high, but not as concerning as where they are now. And you can see that kind of the short-term debt has remained pretty constant. The long-term debt has gone down slightly, but equity in the company has gone down. So whether that's through share buybacks, I imagine, debt now makes up a greater percentage of the company's finance. And if we take a look quickly at the other two, we can see Swisscom has done a very good job of reducing that gearing ratio. So you can see in their case, they must have done equity issues, as again, the short-term and long-term debt kind of remains constant over that time, but the equity amount increases. So that's a good job there by Swisscom. And Proximus, you can see they've done a pretty good job. They've held that stable over 5 years. So that's pretty good working capital allocation and working capital management by Proximus, as you can see there. Now if we move on to the liquidity situation, so cash flow, we kind of touched on the accounts receivable when we discussed Vodafone. So all of these companies are doing a pretty good job of getting paid. Not that Vodafone is not doing a bad job, it's just considerably higher than the others. So net cash flow change. So here I kind of looked at the cash balance of the company to see what movements are happening and how much cash they're keeping in the bank. So if we look at Swisscom, over 5 years, that's about an average plus 5% cash flow movement. So yeah, you can see the changes in cash flow for Swisscom. Nothing too significant, nothing too worrying. Telenor minus 15%. So that would raise a red flag for me. So if we have a look at Telenor now, we can see big injection of cash in 2016 and then from 2017 onwards kind of downhill. I imagine this would be debt repayment, so maybe it's not too much to worry about. But again, as I said before, ideally for the companies that I invest in, I like to look at a stable cash flow. And lastly, Proximus, again, stable cash flow, nothing too much to comment on there, pretty stable. Now onto the investor ratio. So obviously we want good companies in our portfolio, but we also want to get paid. I won't say let's get this money for nothing. So yeah. So if we come to the payout ratios, you can see they're all pretty high. I mean, 65% is kind of what investors say should be the upper limit for a payout ratio. You can see Swisscom is close to that. Telenor is actually paying out more than they earn in profit in dividends. That's definitely unsustainable and another red flag. So yeah, and Proximus, again, 100% of what they earn, they're paying out in dividends based on that ratio. So it's quite worrying if I'm thinking about Telenor and Proximus. That's not going to be sustainable over the long term. They either need to reduce that dividend or generate the profits to be able to continue paying out that dividend as they are right now. So from a price to earnings ratio perspective, investors willing to pay a little more for Telenor than they are for Swisscom and Proximus. But now let's get onto stuff we really like. We like those dividends. So let's have a look at the dividends. So Proximus got the highest dividend yield here, followed by Telenor. Swisscom a bit below, but 4.6% is still a nice dividend yield. And then if we look down kind of at the dividend growth, it's interesting to note that for Proximus and Swisscom, the dividend has not been increased nor cut since about 2012. So it's not good news, but it's not bad news either. If we take a look there, so I put them down. So for Swisscom, it went up from 9 Swiss francs to 22 Swiss francs per share in 2012, and it's stayed like that ever since. So that's a pretty predictable dividend actually. It makes you able to plan for the future. And the same applies, of course, with Proximus. And they cut their dividend actually in 2014 from €1.88 to €1.50 per share. Telenor is actually the most impressive in terms of dividend growth here. We saw 8%. So if we look over the years, so 2011, we had 5 Norwegian kroner per share, growing up and up. The outlier in 2017, they actually paid an exceptional dividend in 2017. So that growth calculation may be slightly distorted. But yeah, overall, solid dividend growth for Telenor. And yeah, from dividend interruption perspective, so only Telenor had the year 2008 when they didn't pay out a dividend. They've paid out a dividend every other year since the 2000s, I think, is the earliest on record that I have. Swisscom, the same, no dividend interruption since 2000. Proximus, no dividend interruptions since 2005, which is kind of when their dividend records start, at least from what I found on the internet. Now, as you may remember from the first time I did this video, I did say that we don't have all the records to be able to include 2020 in the comparison. So this analysis has been up to 2019. 2020 results will be out soon, but for now we'll just have to make do with kind of the quarterly results to kind of see how they've done over 2020. And the story, it's pretty much the same for all of them. As you'll remember, I mentioned that roaming is a big income generator for these telecom operators. So with people not being able to travel, of course, roaming revenues have taken an impact. For Swisscom particularly, they've taken an impact. So Switzerland, of course, not a member of the EU. So the roaming directive on abolished roaming charges doesn't apply there. And trust me, from being in Switzerland, I can tell you roaming charges are high. So yeah, probably a lot of roaming revenue lost out there. Nevertheless, they didn't actually do too bad. I think it was only a 2 or 3% negative impact on their revenues. And they were able to make up for it by saving costs by reducing their OPEX. So that's really encouraging from Swisscom. That's not too much of a drop actually, if you think about it. and it's quite encouraging for the future as well. For Telenor, it's the same story. Their roaming losses relate to Asia, and also kind of prepaid subscriptions from travelers who get SIM cards locally when they go out there. But again, they've made significant operating expense savings. So 8% they made. So they were kind of able to save their EBITDA margins by making those OPEX cuts. I think Proximus is probably the hardest hit of these three companies. So they took a 3.4% revenue impact. But one good thing that they did do is kind of they reduced internet download caps. They've started giving out free Wi-Fi to students, to schools, to help people kind of accustom to this digital way of working that we're going to. And they've offered a lot of promotions and discounts as well to kind of keep their clients on board and to support them through the obvious tough time that was 2020. So short-term impact for Proximus, but the CEO, he's very confident that this will pay off over the long term. Hopefully that the brand will kind of get some recognition, we'll get some more trust and support behind it as a result. Now let's look at the business side for these three companies. So an interesting point to note for Swisscom is that the Swiss government has a 50% stake in the company, which is really interesting. Swisscom competes with Salt and Sunrise, which are the two other major telecom players in the Swiss market. I think it's a fairly balanced market at the moment. A few kind of low-cost players coming in. I think Lidl in Switzerland have launched their own mobile service, and they're trying to undercut the big players. But from a network quality perspective, Swisscom is kind of noted as the best. It has 99.9% coverage in all of Switzerland, and it's also got the 5G network rolled out, and it's got the best 5G coverage as well in the country. I was also really impressed by kind of the business cases and futuristic business model that Swisscom has. So they're providing solutions with drones. They're also providing blockchain solutions when it comes to kind of digital payments and security. They're also generating the energy used to operate their network from 100% renewable energy sources. So that's a really nice thing that they're doing as well. I really like Swisscom actually, quite a nice future outlook on that business. Now if we move on to Telenor, so like a lot of these telecom stocks that I'm analyzing and pointing out to you in these videos, they're also going down the digital route, the Internet of Things, because essentially this is the future of the telecom sector. So one of the solutions that they have is a global IoT SIM. And what this SIM card allows you to do is essentially with that one SIM card is you can go around the world and you can connect to multiple networks at competitive rates thanks to Telenor's solution. So that might be in your phone, your laptop, your tablet, and you've got industrial use cases for it as well, whether in machines or different kinds of appliances. Similar to Swisscom, they're trying to be one of these green operators. So in the Nordic countries, they're currently operating carbon neutral. And their goal is to reduce kind of carbon footprint by 50% in Asia by 2030. And finally, Proximus, also involved in this digital transformation. You can see use cases on their website of a couple of companies that they've helped with, but they also kind of have a consultation business on the digital transformation and helping businesses and individuals plan a strategy to digitalize and transform the way they work, the way they go about everyday life. And I imagine that the goal of that consulting business is to then kind of upsell them onto Proximus and how Proximus can get them onto that digital transformation. Now I mentioned there's a new app in kind of the investing world which is trying to transform the way that we go about investing analysis, and that app is called Genuine Impact. Essentially what Genuine Impact does is it uses a 3-ring system, so based on value, momentum and quality, they assess particular companies and particular stocks to determine whether you should invest in them or not. So just as a disclosure, I invested in a Genuine Impact crowdfunding IPO, but this isn't a paid product placement by them. This is me giving you my honest opinion, my honest review of the app, whilst analyzing these stocks that we've just looked at before. So let's go into the app and see what Genuine Impact says about these companies. So if we start with Swisscom, you can see that blue ring represents the quality, the red, the value of the stock, and the purple, the momentum. So obviously the more full these rings are, kind of the higher the app ranks it. So from a quality perspective, it says Swisscom is pretty good. The value ring is over half, so I think they're seeing that there might be an undervalue option here for Swisscom. And momentum really high, so they're clearly seeing that Swisscom is heading in a nice direction. So let's break down these rings a little bit more and I'll explain what each of them means and how they're assessed. So we're saying it's a medium quality stock. So you can see quality profitability is obviously a very profitable company, as we've seen, nice and efficient. So quality financial strength, weak. So it's not quite what we saw in my assessment. So let's find out a bit more about that. And we can see that it's kind of based on the net debt to equity ratio. So as a result, Genuine Impact has given them a low score for that. Not necessarily a metric I would agree with personally, but yeah, that's how the app has decided to do it. Quality capital allocation, we see sound. So we can see this all based on cash flow, kind of the dividend payout ratio, and the change in dividends per share. And as you remember, they were all stable, what we saw for Swisscom. So we can see that this is nice. Now let's look at the value. So it says that stock is cheap. So we can get a bit more info on that. So it rates this kind of based on the income statement, the balance sheet, and the cash flow statement. So the value for the income statement, it says it's cheap. This is based on price to sales and price to earnings ratio. So we saw kind of stable revenues, stable sales, and they're pretty high as well based on that stock price. So yeah, low price to earnings ratio. So that explains the cheap valuation here. So it's valued medium based on the balance sheet. So it's kind of done this based on the book value of the company. So if you remember, we saw the gearing ratio is about 50-50. So the company has a fair bit of debt, but not too much. And based on kind of the book value calculation, that would explain why it's kind of medium. I guess if that gearing ratio was lower and the company had less debt, then it could probably expect a higher rating for its balance sheet. And then now we look at the cash flow. So it says very cheap. So that's all based on kind of the free cash flow, the free cash flow yield, dividend yield. So we saw decent dividend yield and the cash flow was pretty stable. So the company obviously running with a lot of free cash flow at the end of the year. So this will be the reason why that they've rated it quite cheaply. So yeah, I think so far, apart from maybe the financial strength assessment, I think I agree quite closely with this assessment of Swisscom. And then we've got kind of a nice summary here at the top, which I forgot to look over before. So the things that are kind of pointed out as really good. So dividend yield, yes, we saw that. Accounting strength, yeah, we saw the books looking good. Yeah, so fair assessment of Swisscom in the Genuine Impact app there. Now let's take a quick look at the other two, so Proximus. So you can see the value and momentum rings are quite full, but the quality not so high. So why is it talking about that? Okay, yeah, so historical growth, historical return. Yeah, we've seen that kind of the revenues are decreasing over time. And if we look at the share chart, I'll put that on the screen for you. That share price over time is typically decreasing. Nice dividend yield, as we saw kind of in my analysis as well. And value, yeah, based on that share price right now. It's pretty good, it's fairly good value, but yeah, concerns kind of around its financial quality going forward. Then finally, if we take a quick look at Telenor, so we can see kind of mid-quality stock, fairly undervalued, but gaining momentum. So if we have a look again at why that might be, momentum, yeah, so momentum, yeah, we saw that the revenues over the long term, they're growing. Historical growth, however, is a negative. And if you actually look back at kind of the Excel sheet that we have, we see that the net income is actually trending generally downwards over the long term. So I can understand that. Excellent dividend yield, as we saw before. So yeah, weak financial strength. We obviously saw that the company has a lot of debt kind of on its books. Now if we go back, so we look at the value, it considers it cheap. And momentum, yeah, so we saw constant revenue growth. Earnings, it does say very strong. So yeah, decent earnings. I mean, they have trended down, but they're looking okay, I would say. And then sentiment, obviously investors maybe not feeling so confident about that. So yeah, overall, I think the assessments in Genuine Impact are pretty good, pretty accurate based on my own assessment. The only thing is where we've kind of seen discrepancies, it would be good to kind of have some numbers in there. Some explanations of the calculations with the numbers to see how they've done it and how they've come out with a different result to myself or to you if that's you doing the assessment, for example. But yeah, really nice app, has a lot of potential, so I'm definitely going to keep my eye on it, keep looking at the new stuff that they're constantly adding, and yeah, hopefully it can be of use in my investing going forward. Okay guys, so based on the assessment of the three companies, obviously we discarded Vodafone at the start, remember, it's too many red flags in there for me to consider it. Proximus is a fairly healthy financial company, but I'm concerned about the declining revenues going forward. And the fact that they've kind of added more discounts and promotions in to try and drive that client growth, I think at least in the short term, that profitability will be hit. And I don't think revenues are going to come back up too soon. Telenor obviously has really nice revenue growth and profitability, but the debt situation of the company is a major red flag. I can't see myself sitting comfortably with that if my money was in that stock at the time of doing this video. Swisscom is not mind-blowing from a financial perspective, but I think of the three overall, I think it's in the best financial position, assessed on kind of those four criteria that we looked at. It's the one I would probably put my money in, based on kind of its stable revenues, its debt situation, and the dividend yield that we get from it as well. So what are we gonna do? We're gonna buy it and we're gonna put it in that trading 212 pie, and you're gonna see it very soon. So Swisscom makes it into the trading 212 pie following this video. That update will be coming out at the end of January, so make sure you're subscribed and click the bell for notifications. Also, if you've got any stocks or industries that you'd like me to look at or do a video on, why not leave a comment below and I will consider making a video about it. That's all from today's video. I hope you enjoyed it, and if you did, make sure you tell another millennial that this channel is where the good stuff goes down. Be sure to check out the Millennials is Money social media and internet pages, and also the other videos on this channel. I'll see you on the next one, and let's get this money.